But I feel like we could see this market run up potentially into May or so. As the saying goes, you sell in May and go away. And if we take a look at the seasonality chart of the SP 500, typically from January up into May, June, July area, this is usually a strong type of market condition. And I believe that we've got a couple months left of the market kind of hitting new all-time highs, the AI stocks, Nvidia, all these things sucking people in who aren't yet in the markets. And then I think just as they all get positioned, we'll probably start to see some big selling later this year. We saw a big distribution day about a week and a half ago, 2 weeks ago, where everything sold off with big volume. And that is a sign that somebody's out there unloading their big chunks of their portfolios. And so that is what we'll be looking for come May, June, July. If we start seeing more of those, or maybe we even start seeing more of those leading into it, that is definitely a big red flag that big institutions are now trying to get out because they feel like the market is topping. And once the institutionals start selling and they hear about others are selling, it just creates a self-fulfilling prophecy. They all start unloading. They want to sell before the other institutions. And we go into a big sell-off, and it turns into a feeding frenzy of who can sell the fastest and a big sell-off. So that's kind of, I'm bullish, I think, still until we get into May potentially. And then I think we definitely want to keep our eyes peeled for some selling in the markets.
On this episode of What the Finance Podcast, I have the pleasure of welcoming back Chris Vermeulen. So Chris, thanks so much for coming back on the podcast today.
Hey, thanks for having me, Anthony. A pleasure.
No problem. And yeah, I'm looking forward to the conversation. I know last time you were talking about sort of you think the markets, you obviously focus on momentum. It was quite bullish, but you weren't sure if maybe how long that could last. And as we see, it sort of lasted quite a while. But yeah, I guess from your perspective, what are you currently seeing in the markets, and what are you paying attention to?
Sure. Yeah, there's a lot going on in the markets. I think there's a big shift right now between I think a lot of people who haven't been involved in the markets, who were scared to get in last year, they haven't got in yet. I think the market is doing a good job right now of trying to pull them back into the marketplace. We've got headline news, stock indexes hitting all-time highs. Nvidia seems to just like run the whole markets now. Everybody wants to own Nvidia. So we're definitely starting to see the general public on top of that starting to move in. People are starting to buy shares of Nvidia just because their friends own it, or it's headline news. So let me share my screen here, and I'll show you kind of some interesting angles on this chart.
Yeah,
just see if I can get this to pull up. All right. So what I find really interesting is when we look at the stock market as a whole. So if I was to just look at the SP 500, this goes back to just before COVID. More or less, we've got the SP 500 hitting new all-time highs. We have the NASDAQ as well hitting new all-time highs. And that has to do with the big, whatever they call it, the Super 7 companies, the big techs really driving these indexes to new highs. What I find really interesting is if we were to look at, say, the SP 500 and look at the equal weighting. So this is the equal weighted. Each company has got the same value or weighting to the index. You can see we're actually not at all-time highs. We're actually getting close to a major double top. So this is what's happening behind the scenes. If you get rid of the hype stocks or the big tech that has everybody's attention is dragging the major indexes up, the reality is majority of stocks are actually coming up to a major resistance area. And another angle to look at this is the Russell 2000. Russell 2000 is the majority of stocks. I mean, this is thousands of them. This is what a lot of people want to be involved in because they're small cap growth stocks. And as you can see, there's been a big downward trend here, and then it's been trading sideways, and it's stuck right here kind of at resistance as well. And so this is a really good gauge of the overall market trend. And if we were to blend those two together, so I like to look at the SP 500 as the ocean tide. If the SP 500 is going up, is usually a bullish tide. Everything's going to go up. If it's going down, you don't really want to hold stocks. So if we look at the equal weighted SP 500 and the Russell 2000, this gives us a view of the overall market. And the key here is to see that we've gone into this big, huge move with a blow off top coming out of COVID. We went into a bear market and a big sell-off in 2022. And now we are in this complacency mode, which is a big bearish pattern that eventually shows we should eventually go into a big sell-off. And I consider this pattern here a stage 3 topping pattern. And after this comes a very big bear market. And if I can just show this chart here on stage analysis, there's 4 stages the markets go through. I'm a technical trader, whoops. And my focus as a technical trader is to follow price. I don't care about news. I don't care about the economy. I don't care about the Fed. All we want as investors is for our investments to go up in value. If they're not, we don't want to own it. And so, we've got these 4 stages that the markets go through. And this is that stage that you were just asking, what's the SP 500, the NASDAQ doing? This is what they're doing under disguise. When you peel back the top big stocks, the majority of the market is in this complacency move, getting ready to go into a big financial reset, I think. And so that is, what a lot of people, I don't think, understand. And the market has a perfect way of attracting and getting everybody involved in the market just before it puts in a major top. And the SP 500 actually did do something similar to this. If we look at the weekly chart and go back to 2008, we can go back here and take a look at here. You can see the market actually came up. It put in a new all-time high. It sold off and it broke down. This was a much smaller complacency move, and it rolled over and sold off about 54%. So we're kind of in this double topping phase in the markets. And then we go into this potentially a multi-year correction in the markets. I actually feel like we could see a multi-year correction very similar to the tech bubble. I feel like we're in kind of another tech bubble. And I think we're seeing the US dollar, we're seeing different commodities kind of all in line that are telling us that I think we're close to a cycle like this where we're going to see the equities markets go out of favor for a very long time, much longer than people think. And we're going to probably see other opportunities in commodities down the road. So that's kind of my high level view of where we are right now, with the stock markets kind of hiding what's really going on just because these 2 indexes are very tech heavy and weighted to the upside.
Yeah, it's really interesting. So I think you were talking about there. So with the S&P 500, the one that's actually, I guess, evenly weighted, so it's not actually weighted based on like market cap. You think there's going to be sort of a double top coming in the near future? So is that where you think there's going to be potentially the peak of the bullish momentum in the short term, or what are you watching there?
Yeah, I mean, I think we've got a little bit of room to go here with the equal weighted index to hit some new highs. This could still drag out for a few weeks. The market could correct. We could very easily still poke to some nominal new highs with the equal weighted SP 500. And that's perfectly fine. Typically, the market is going to want to do this. The market loves to hit new highs or new lows. That's how it can run stops. That's how it plays the maximum emotions of investors. But I feel like we could see this market run up potentially into May or so. As the saying goes, you sell in May and go away. And if we take a look at the seasonality chart of the SP 500, typically from January up into May, June, July area, this is usually a strong type of market condition. And I believe that we've got a couple months left of the market kind of hitting new all-time highs, the AI stocks, Nvidia, all these things sucking people in who aren't yet in the markets. And then I think just as they all get positioned, we'll probably start to see some big selling later this year. We saw a big distribution day about a week and a half ago, 2 weeks ago, where everything sold off with big volume. And that is a sign that somebody's out there unloading their big chunks of their portfolios. And so that is what we'll be looking for come May, June, July. If we start seeing more of those, or maybe we even start seeing more of those leading into it, that is definitely a big red flag that big institutions are now trying to get out because they feel like the market is topping. And once the institutionals start selling and they hear about others are selling, it just creates a self-fulfilling prophecy. They all start unloading. They want to sell before the other institutions, and we go into a big sell-off, and it turns into a feeding frenzy of who can sell the fastest and a big sell-off. So that's kind of, I'm bullish, I think, still until we get into May potentially. And then I think we definitely want to keep our eyes peeled for some selling in the markets.
Okay, so I guess what would you need to see to, I guess, change from bullish to bearish? Is it just that increasing volume? Is it those large sells, or what else would you have to see?
More or less, yeah, if we start to see like the Russell 2000, we see growth stocks starting to sell off and drop. If we see elevated volume on the down days, typically it takes high volume days to drive the market down. There's typically a trickle effect of money constantly going into the stock market from people's paychecks every day, every week, every month, institutions rolling in with new investment capital. So, in order to drive the market down, you not only have to match that volume, that daily inflow, with selling pressure, but then you actually need to have more to drive it down. So if we start seeing elevated volume on the down days, then we know sellers are lurking out there. And if we start to see the Russell 2000 break down, um, get down to the lower end of its range down back over here, if it starts to break down, that'll definitely be a warning sign that we could see the big indexes really run out of speed and start to sell off. Another thing that we tend to see is actually gold, silver, and miners. They can perform really well here in this last little phase. In fact, this is the weekly chart of gold miners, but in a nutshell, you can see back over here in 2007, 2008 during the top, gold miners and silver and gold both, they all rallied very strongly just before the stock market started to roll over. And so I think we're very similar setup. You look at a lot of the major gold stocks, silver stocks, and just these ETFs in general, they're all getting oversold. They're all down at short-term support zones, ready to bounce. So we're in this potential little perfect storm to see the precious metal space rally. And if they start to rally really strong here over the next couple of weeks, that to me is also a warning sign that we are very close to the stock market selling off and driving things down. So there's a lot of other things that come into play. I want to see what money is doing. Is it going into the dollar? Is it going into gold? What are utilities doing? What is the US dollar doing? What is the VIX doing? All these things kind of come into play because everything is related and connected in some way. And so how the money moves through assets and how quickly it's moving to certain ones, to me, is a gauge of the overall fear or complacency in the market that usually signals a bottom or a top is happening. And I'm a technical trader, so no matter what everything says, I still need price to start to trend lower. Lower highs, lower lows, support needs to be broken. So it doesn't matter what chart it is, we still need to see the trend reverse and break down. And it'll take a lot of damage to this chart to start a new bear market. But right now, I think it's got a lot of upside potential. I'm expecting we're going to see some big volatility, probably generate some type of topping phase here. And then the question, if it starts to break down below this level, that's when we could start to see things pick up and go into a much deeper correction. So I'll be looking for increased volatility, some type of range that it eventually breaks down from.
Okay. And what would change your mind to say if it's, is there a chance it could just continue to keep going up? What do you think?
Yeah, I mean, nothing has changed my mind. We're long the markets. You can't fight the trend. So we're long as long-term investors with very passive capital invested in the markets. We're long as short-term traders. I mean, we follow trends. That's the nice thing about technical analysis. If it's trending up, we're long. So there's nothing it needs to prove. This could continue to go on for a long time for all we know. And that's the nice thing about following trends and prices. We don't need to know where the heck it's going. We just need to be able to follow it really well. And that's what we focus on, is if we can identify trends, new strong trends as they form, and we can get in and trade those and manage those positions so we're able to lock in gains, reduce our exposure as it matures, then you're golden. And it eliminates not all, but a huge chunk of the stress, because now you don't care about news. You don't care what the Fed does. You don't care about Nvidia. All you do is you follow the price and of whatever asset it is, and you trade whatever stage that asset is in or whatever trend it's in. You follow and trade, accordingly.
Yeah, it's sort of trying to avoid all that noise that you see in the
It's hard to
fundamentals
avoid that noise.
Yeah.
We are inundated with it. It's pretty wild.
Definitely. So if you look at, I guess, the stocks like Nvidia that have been, Meta that have been driving out the markets, would you say it's too late to get into them, or you think it's sort of very uncertain, there's going to be lots of volatility in the near term, as you were saying, similar to the other markets?
Yeah, I mean, Nvidia has hit a very significant measured move. I was actually talking about this earlier today. It's up about 60% on the year, almost 600%. Well, the spike high from not that long ago is about 600%. It has hit a Fibonacci measured move. Now, Fibonacci is um, one of the most powerful tools I think that you can use, and I use Fibonacci extension to I understand where these movements are. And when I use this, I like to look at the 618 level, which is an extension from this pattern. And I like to look at the 100% level. And if we were to zoom in on this chart, so the way it works is you take this low, you'll take the high of the consolidation, and then you take this low. And once we apply that, it extends that momentum up two different levels. And my general rule is if price hits the 618 extension and takes a bit of a pause, that means you've got your analysis correct, and almost always do we go up, and we'll see that 100% measured move hit, and we hit that move. We actually saw this several weeks ago, about a month and a half ago. We talked about this, about a month and a half ago. We said 784 is probably the next major target, and when we look at the daily chart, you can really see how this played out. So if we were to just look at this daily chart, what's really interesting is we had this low and the rally up, and here's the 618 level on Nvidia, and you can see here it hit that level and it paused. And if it pauses under that level, then you're pretty much going to go up and hit this 100% level. So I think most of the upside, as you mentioned there, Anthony, I think most of the upside is done right now. It's hit its target based on its big multi-month chart pattern. So now we're in bubble phase. How much of the general public is going to pile in? How emotional are institutions to keep accumulating this? Is it going to pop to $1,000? Is it about to drop? This type of scenario, I'm expecting a pop and a drop, and eventually it'll probably correct and have a bigger correction. But right now it's kind of in bubble phase. It's just a wild card at this point.
Yeah, that's really interesting looking at that. So would you say once it breaks the 60%, and that's when you think that it's sort of further to go down? Is it sort of similar on the way down as it is on the way up, or is it something else you're watching?
Yeah, there's a few different levels we could look at. I think it really depends on the type of pullback or correction that we get. We can use Fibonacci retracement to get an idea from these lows down here up to this high. If it was to pull back, I wouldn't be surprised if we see it come right back down here. This is a 0.38. This is typically a very strong level for it to find support. It could bounce or build some bear flag. And then the 50% pullback, which is 50% from the low to the high. This is right in the middle. And so it's got potential to come back down to this, 560, 616 kind of level to potentially find some support. And the thing is, when you look at this chart, if we were to just zoom way out, you can see how parabolic this has gone. And it has done this before. It's gone in one of these parabolic moves, and usually something that goes parabolic and straight up usually comes back down for about half of that move. And if we were to look at half of that move, you can see if we were to go into a bear market and we go for this full move, that brings us down to about 464. So we're looking at a pretty big haircut, 45% or so. If we go into a bear market and this corrects, like this company's on fire with AI and everybody seems to want it. But what goes straight up will usually come straight back down. And it would be actually interesting just to take a look here at this rally. If we were to do a Fibonacci retracement from this cycle low to this high and see where it pulled back, you can see it pulled back much further. It pulled back way below that level. So, I mean, individual stocks are very volatile. And definitely when you have the mass psychology of people piling in, it can create much bigger moves than just Fibonacci. You get these blow off moves, whether it's a blow off top or a washout low where everybody just panics out at the same time and it just collapses. So we just have to see how that unfolds.
Yeah, makes sense. So what do you need to see to turn bearish? I know you mentioned these, you've mentioned all these signals that you're watching for, but then what would it actually take for you to then take off your long and then potentially go short?
For the stock market or for Nvidia?
Stock market.
Yeah. So for the stock market, more or less, we're going to have a trailing stop get hit. So if this was to start to flatline and start to move over, if it pulls back enough, we've got a stop that moves up in place. So we would our stop would kick us out, lock in our gains, and then we would be out of it, and we'd look for a new setup. Or we might just have the trend change, meaning it might lose its momentum. A bunch of those market internals I mentioned earlier all start to change where the money's flowing, and our strategy will say, hey, the trend is actually ending. It's weakening underneath the hood. Close out the position, and the market doesn't have to fall for that. It could just trade sideways long enough and say, okay, step aside because this market is showing signs of weakness. And then, of course, whenever the market breaks either to the downside or the upside, then we would have a new opportunity to get back in. So it really comes down to price correcting, either going sideways long enough or pulling back enough to kick us out and hit our protective stop.
Okay. And then would you flip straight to short, or then what would you have to see to flip to a short?
We would most likely be moving into the US dollar ETF. UUP is the symbol. Depending, as long as it's in a new uptrend and holding its ground, that's where we'd go for safety. Typically, when the stock market goes sideways or down, we tend to see the dollar rally. If the dollar is not favorable, sometimes we go into TLT, which is the bond fund, but because of the rising interest rate environment, we haven't traded that for a couple of years until the market conditions change. So we might go into BIL, which is a 1 to 3 month treasury note ETF. You just collect daily interest. If you hold it long enough each month, you get paid out in a dividend. So it allows us to put our money on the sidelines and still earn daily income while we wait for a new opportunity.
Yeah, makes sense. Really interesting. So, you mentioned there at the start of the interview, you were saying that there's a risk of potentially 50% drawdowns in the market. So, yeah, is that something that you see? And I guess if you would you use a Fibonacci on the S&P as well?
Yeah. So, I mean, let me just clear some of these things here. So depending on how we look at things, we can look at a few different views. So we've got the 2022 low. So this would be the more conservative play. There's potential for the SP 500 at this point to pull back roughly 14 to about 19% or so. If we actually look at the COVID, the start of the rally from COVID, that brings us down potentially to around almost a 30% correction. And that's if we hit this 50% level. There's potential we could go even further. And depending on how far back we want to go, there's all kinds of different significant lows in this market. There's a low back here in 2018. We had a significant kind of slowness in the economy in 2015, 2016, which we could do a Fibonacci retracement. Overall, if you were to take these significant lows, including the 2009 low, it brings us down about 50% on average where these levels are. So that brings us back down pretty darn close to these COVID lows, wipe out a lot of people's gains. This will apply a ton of pain on individuals, and we'll see how things go from there. But that's kind of how I come about this from major cycles. You kind of step your way back and you look where most of these retracements align. That's probably where the market is going to try and run down to, where they all have a common value at the same dollar range.
Okay, that makes sense. And then if you were to say, if you flip into the dollar because you see the dollar strong and then the markets are weak, maybe you can go over the dollar first before I ask my next question.
Sure. Yeah. So if we take a look at the dollar is very, very close to a similar setup as I believe the tech bubble. I think we're in another tech bubble right now. So we can see the dollar move up as the stock market sells off. And I believe right now the dollar, which is in a strong uptrend, I think if the stock market starts to sell off this year, we'll see the dollar move up. And just like we saw back during the last tech bubble, we see safety move to the dollar. And then eventually we're probably going to see this run out of steam. And then the dollar is going to sell off. As we can see last time, it sold off. It started a major super cycle in commodities. And so we see this huge multi-year sell-off. And that's what sparks a huge move really in the precious metal space. And I think this is going to be the start of a new massive super cycle for precious metals, potentially uranium on a different angle. It's going to be really interesting to see how this unfolds. But the dollar, I mean, the dollar is a very slow moving asset, but it's a pretty amazing play. I think there's potential for about a 10% to about a 15% move to the upside, which doesn't seem like much, but I'll tell you, it is pretty amazing. Like when you look at 2022, the stock market entered a bear market, stock market collapsed, and the dollar rallied about 20% in a very slow, conservative way. The pullbacks for the dollar were like 3.5%, 4%. Very, very manageable from an emotion standpoint. And to watch your account go up as everyone else is losing their shirts in a very controlled environment, I mean, that's what we'll be looking for the US dollar again here. And people skip the currency. They don't think they need it, especially if you're in America. People are like, why do I want to own the US dollar? I live in the dollar. I already have the dollar. The dollar index actually goes up in value. It's a great play, not just for international people, but it's an ETF that goes up in value. And it's probably one of the most overlooked positions to take when all hell is breaking loose in the markets. You can sidestep it and move into this and have a really easy way low volatility way to generate gains when everyone else is losing money.
Yeah, it's a good point. I've definitely been surprised that it had that pullback, but as you said, it looks like it's positioned to potentially have a further increase from here. You mentioned uranium, so I'd be interested to get your opinion on that, because I guess that's something that's had a massive parabolic, probably similar to the Nvidia in the near term. But then it does look like it's toppy. But but what's your opinion on that?
Yeah, so uranium has been out of favor forever. If we were to kind of go back and look at the stage analysis here, you can see it's more or less in a stage one. It has been trading sideways forever. It's starting to build a little bit of a base, and I think it's going to have its stage two. It's time to shine in due time. So you can see it's gone through a stage four. It's been out of favor forever. Now it's building a launch pad. Early investors are getting in. The aggressive investors are piling in because they see the potential of no one can get their hands on uranium, and everybody wants to use uranium, it seems. So this is a launch pad. I think we could have a little bit of weakness still as the stock market struggles, but overall, I do think this is one of those plays that could go parabolic and take off. So this is a really exciting chart pattern. I think gold miners and silver miners are going to be equally exciting, but this one definitely has a really clean chart. And, this I think has got that potential to really skyrocket in value, several 100%, which is a pretty good opportunity.
Yeah, definitely. So back to my other question I was going to ask. I guess you're mentioning that you will probably look to go into the dollar rather than shorting the S&P once you think it's in a bearish scenario and the dollar's quite well set up. So I guess what would be the catalyst for switching back to the markets? Would that just be sort of the opposite where, the dollar is looking like it's reached a peak and then the S&P is looking like it's bottoms?
Yeah, it'll be kind of the flip. So more or less we need, once a major downtrend starts, which takes quite a bit of time, several months and a lot of price correction, it's the same for a market bottom. We'll see the market put in a bottom. It'll put in a very strong rally, could be 20, 30% or so. And because it takes time for these the market to flip from a bull market to a bear market, and then from that bear market back into a bull market. So it takes time. We need the trends to turn up on the shorter time frame, the longer time frame. And of course, we want to see money piling into the growth stocks at that point. We want to see people piling into tech, biotech. We'll probably see precious metals and miners do really well. They seem to be actually one of the first sectors that actually bottom before the stock market even does. So we'll be looking for price, and then also where's the money flowing? Is it flowing into really aggressive stuff? Are people, picking up these undervalued, beat up companies that are, screaming opportunities? And if they are, then we're probably starting that new raging bull market that was very similar to like right after COVID. That was a raging bull market. Throw a dart, buy whatever you want. Everything just screamed higher. But we need a reset, a big financial crash and reset to bring that opportunity back. So it just will take time for those trends to take place.
Yeah, it makes sense. So I guess for people who are just getting into technical analysis, it's not something, to be honest, that we talk about much on the podcast. A lot of people are more into fundamentals and using that to I guess put their positions on. But yeah, so can you maybe give us a little bit of an introduction into, I know you've sort of talked about at the start, but into your technical analysis, and it seems like you're focusing very much on the longer term trends rather than, I guess, lots of people trying to go minute and 5 minute range.
Yeah, well, I'm just trying to give the big picture view of what's coming. I focus on the daily and the 30-minute chart every day with subscribers. I'm just trying to give the big picture analysis. But when it comes to if you apply both technical and fundamental analysis at the start of a new bull market, where you find companies that are way undervalued, they have a superior product, they got the right team in place, and the chart matches up, and you have buy signal. I mean, that's what can create some of the most powerful moves in the market. So there's nothing wrong with fundamental analysis and things like that. I just believe there's a time when it's really, really useful to make sure you pick the best stocks during a new bull market. In terms of like the overall technical analysis, I think the key really is to follow the trends. I like to know what these big trends are doing. I have a bearish bias on the markets, but we are actually long equities. If we take a look, the SP 500, our technical analysis saying, we want to be long here. We've been long since November. Same with the NASDAQ. We get in, we ride these up. So I'm long, I'm bullish. I believe this market's going to go higher until proven guilty, until it reverses and kicks us out of the trade. Until then, we just sit here and ride this trend up until the price turns, and then we exit that position. And actually, one of the tools that I use is this custom kind of sentiment and panic indicator. And so this is the QQQ, same chart as on the left, just color coded differently. And I've got a design that when we're in an uptrend and we get these red bars are telling us people are betting against the market. They're panicking because they think this market is going to keep going down. And here they think it's going to continue. It's actually going to roll over. So they're betting on the downside. Same over here. They think it's going down. Here they finally say, okay, this has got to be the top. It's going down. And whenever we get these scenarios, we tend to see the market go in the opposite direction. These people here are the people trying to pick bottoms, the people trying to pick tops, and they just keep getting beaten down. And when we get these awesome signals and these moves to the upside. And if you understand crowd psychology, and I can track where money's flowing, and when we know where it's flowing and what direction and how much, we know what they're thinking and what they're doing with their money. And when we know what the majority are doing with their money, we can take the opposite side and we can bet against them. And that's what this chart allows us to do. So there's some pretty amazing analysis you can do if you understand intermarket analysis. You don't only get price action, but now we know what the average Joe is doing. And whenever all the average Joes are doing the same thing, the chart screams to us saying, okay, here we go. They're all positioned on the wrong side. They're about to be left behind again. So, I mean, there's technical analysis is very powerful when you understand how to pull all the layers together and understand what they do. So it's pretty exciting stuff.
Yeah, really interesting. I imagine it works the opposite way as well. So once, I'm sure there's times where people, when in the bear market, it's people are like, oh yeah, this is the time it's going to break out, and then it doesn't. It just keeps going.
Exactly. In a falling trend, whenever we get dark green bars after a bounce, we know everybody's bullish. They think it's going higher, and then the market tanks. So if it works the exact opposite in a downtrend, it's pretty powerful.
Yeah, makes sense. So, Chris, thanks so much for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
One last message. I think it's important to understand the big market cycles, that we could be coming into a big stage 4. I don't want to be doom and gloom, but if you're not prepared for it, if you don't have an exit plan to protect your capital, even just moving to the sidelines, if all hell breaks loose, it is way better to just collect 5% interest a year than it is to lose 30, 40, 50% and then take 10 years to gain it back. I think people who are actively trading need to understand the big picture, and whoever are passive investors with like an advisor where their money's just kind of set it and forget it, buy and hold, they should ask their advisors, how much risk do I have if the stock market corrects like 50%? I think most people will be blown away. The buy and hold strategy is a very high risk strategy. And if you like short-term analysis, I mean, technical analysis is a great way to take advantage of the markets and play moves on a daily basis, intraday basis. I mean, I love the 30-minute chart of the markets to be able to catch nice momentum moves.
Perfect. Makes sense. So yeah, Chris, thanks so much for your time today. I really appreciate it.
Hey, thanks, Anthony. Always a pleasure.